So very good afternoon. So we start topic 3, the corporate risk management. And as you can see that this topic, I wrote part 1 here. Part 1 means that there'll be more than one part of this topic. There'll be two topics, there'll be two parts of this topic. So topic 3 will be having two sets of slides, the corporate risk management part 1 and corporate risk management part 2. And you can see I wrote in the green letters that this topic is the basis of your second task. Just to repeat the nature of the first task. In the first task, as you have done already, we are doing the financial ratio analysis. And in these ratios, we are trying to find out which are the pluses and the minuses of the company, which are the good things, which are the strengths, and which are the weaknesses of the companies. To make these strengths into opportunities, what should you do? To take care of these weaknesses before they become threats, what can you do? That is the core, the essence of this first exercise. So, as I said repeatedly before, the first task is about risk diagnosing where the problem is. Whereas in the second task, we will be giving some kind of treatment that how we can, if we can see a writing on the wall that, hey, there is the risk and there will be a risk to any company. I'm yet to see a company which claims that, hey, I don't have any risk. I'm yet to see that company. You will also find out the risk. And this risk, we will be failing in our efforts if we are not able to suggest some strong remedy to the company, okay? And that exactly is the objective of the second task, which the basis of the second task is the corporate risk management, which we shall be starting today, okay? So this is some kind of background of the company, of the second task. So the topic objective is very important, that in the accounting, in the first task, you must be, as I said before, you must have highlighted some risk. How can we overcome? How can we make a plan to minimize those risks through the active, the head-on risk management policy? And the second of this topic is to use some derivative instruments. Derivative instruments are like, we use the financial insurance policy. Like if you are running a factory and there's always a danger that there can be fire, you must take the fire insurance, okay? So if you run a company and you know that these are the points where the risk can devastate the company, okay? Then we need to know that which type of insurances we can buy so that we can take care of, we can settle, we can manage this risky situation, okay? And the third objective is that how the financial institution can come, the banks, how the insurance companies come in the picture, and how you will be making a risk management policy based on the risks and its analysis. So primarily your task 2 would be point 4 here, that you will be preparing a risk management policy of the company you have chosen, okay? So point 4 in the topic objectives is very, very crucial, okay? That's what we shall do in this topic. And as I said, that this is not a one part, but 2-part topic. So part 1 we shall do today. We will not be able to finish the whole topic today. Of course, we'll carry it on, no worries. But this will be a very interesting topic for you, hopefully. All right. So based on your assignment 1, I just make a list of some points that what type of risk you may come across, because in the task 1, at some stage, you must have highlighted that these are the risks which can cripple the company. You might find that maybe the costs are rising in the company, or the revenue is falling short, or is it so that your debt is increasing and the finance cost is increasing? It could be that your cash cycle is increasing, so you have to maintain more cash with you, and that could be an extra burden on you because this cash is basically stuck. If you have a very big cash cycle, it means that you need to keep more money with you. With that money which you cannot use, basically, might be you have to borrow this money, and you have to pay a huge amount of interest on it. So it's very important that you are able to. So some of this cost. So see the last sentence. I say, can you explain the above risk in the light of the foreign exchange fluctuations? Your cost can be. So the point I'm trying to make here is that you may highlight in your first assignment that maybe your costs are rising. But then related that if you are a company who's importing something from abroad, it could be possible that your cost is rising because the currency in which you make payment has become expensive. Now imagine you are a company and you are importing 1,000 kilograms of some raw material from Canada, and you are making payment in the Canadian dollars, okay? And let's say that 1 Canadian dollar is equal to half euro. It means that if a kilo, let me make it again. You are importing something from Canada, and let's keep it simple, 1,000 kilograms of some raw material, and the cost is that a kilo is for 1 Canadian dollars. So it means that if you buy 1,000 kilos of this raw material in Canada, you pay 1,000 Canadian dollars. So it means to make a payment, you need 1,000 Canadian dollars. And because you're living in Finland and you're buying it from Canada, there is a transaction, there's a conversion of two currencies, so that you make payment in euro, and then you convert euro to Canadian dollars, and then you make a payment. Now imagine the exchange rate is 1 Canadian dollar equals half a euro, and you need to pay 1,000 Canadian dollars. Because it's a half a euro equal to 1 Canadian dollar, it means that you will make a payment of 500 euros. 500 euros. So to buy the raw material, whose tag price is 1,000 Canadian dollars, and when you are in Finland and you are going to buy it, you need to make a payment of 500 euros. Of course, there'll be other payments like import duty and stuff like that, but that's a different thing. So to buy this packet of raw material of 1,000 kilos, you need to pay 500 euros. Now imagine, you still need 1,000 kilos of this raw material. And guess what happens? The Canadian dollar is no longer equal to half euro. The Canadian dollar is no longer equal to half euro. Now the Canadian dollar is equal to 3/4 of a euro, or 75 cents. In this case, your import bill in euros will not be 500 euros. It will be 750 euros. Earlier, your cost was 500 euros. Now, to buy the same packet of 1,000 kilo of raw material from Canada, which cost 1,000 Canadian dollars in Canadian market, But because you're buying it, you're importing it from Finland, you have to convert euros to Canadian dollars. And now, because the rate of exchange is no longer 1 Canadian dollar equal to half a euro, rather, it is now 1 Canadian dollar equal to 0.75 euro. So now this import will cost you 750 euros. Earlier, it was costing 500 euros. Now it costs you 750 euros. Guess what? Your 50% cost of raw material has increased. And if you remember, last week we discussed that there is a concept called cost of production and cost of goods sold. And one of the major component of the cost is the raw material. And if the raw material is imported, then the cost can go up and down depending upon the rate of exchange. So it could be possible that the cost has risen. Okay. So it means that now you know that your cost has jumped from 500 euros to 750 euros. So there is a 50% increase in your cost. Even though you import the same quantity, you're wondering, hey, why the cost has increased? We are still buying the same amount of raw material. Hey, you know what? It's not that. It's the price of the Canadian dollar which has increased. The company in Canada is not charging more money from you. Okay. You are not importing more quantity of raw material, but because of this market mechanism, this fluctuations, the market mechanism we discussed a lot in the economics course, that when the demand of something goes up or the supply of something goes down, the price goes up. So in this case, the price of Canadian dollar has gone up from 50 European cents to 75 European cents. That is from half a euro to 3/4 of a euro. My question to you, when 1 Canadian dollar is no longer half euro, or it used to be half euro, and now 1 Canadian dollar is equal to 75 cents or 0.75 euro, what would you call this phenomena as? So it means that the Canadian dollar has appreciated. It has become more expensive. And at the same time, euro has depreciated. Because earlier you were giving half a euro to get a worth of 1 Canadian dollar. Now you have to pay 3/4 of a euro to get the worth of 1 Canadian dollar. So it means that, so we learn something, that if we talk about the cost, if the risk is in the cost, it could be possible that the currency in which you import has appreciated against the domestic currency. So we make some kind of generalization that, remember in the task 2, you have to make some kind of assumptions that, okay, this could be a possible reason. So that the cost has risen because we were importing some raw material and the currency in which we were making the payment has appreciated against the domestic currency. Okay. The second reason could be that the revenue which you remember, you talk about total revenue in the income statement. And if you are a multinational company, which you quite likely are, you will be getting revenue from different countries, different currencies, and you add it up, and then you make a kind of consolidated income statement. That's why you see the word consolidated, because all the revenues coming from different countries, domestic, abroad, put together. If you're a company like Coke or Pepsi, you are adding the revenue in the consolidated income statement for over 150 countries. And there could be over 100 currencies involved in it. Okay, so the exchange rate fluctuations can also affect your revenue. I'll give you an example. Imagine you have a operation in Malaysia, Okay. In Malaysia, your customer will be paying you ringgits, Malaysian ringgits. Um, just imagine you made a sales of 2,000 Malaysian ringgit. You made a sales of 2,000 Malaysian ringgits in the Malaysian market. And let's say the rate of exchange is that 1 Malaysian ringgit is equal to 1 euro. It means that if 1 Malaysian ringgit is equal to 1 euro, and you have made a sales of 2,000 Malaysian ringgits in Malaysia, and when you want to when you want to bring this money back to Finland, okay, in that case, sorry, in this case, if you convert this this sales revenue, I brought the switch off my phone. So when you are bringing this money back from Malaysia to Finland, I repeat, you made a sales of 2,000 Malaysian ringgit, and the rate of exchange is 1 Malaysian ringgit is equal to 1 euro. You as an exporter get 2,000 euros in domestic currency. Now imagine your sales in Malaysia are still 2,000 ringgits worth. Nothing has changed. But guess what? Malaysian ringgit is equal to half a euro now. Earlier, you could buy a Malaysian ringgit with 1 euro. Now you only pay half a euro and you buy a Malaysian ringgit. May I ask you, which currency has appreciated or which has depreciated?
The Malaysian.
I'll resume. Now, you said it very right, Mari, that when the Malaysian, in this case, when Malaysian ringgit was equal to 1 euro, now it is 1 Malaysian ringgit is equal to half a euro. In this situation, Malaysian ringgit has depreciated, or the domestic currency euro has appreciated. So rule of thumb, if the currency of export depreciates, it hits you. Look, it's very interesting. If the currency of import of raw material or something appreciate, and if the currency of export depreciate, it's dangerous from both sides. So it's a double whammy. You pay more revenue, you pay more cost, and you earn less revenue. On the contrary,
can you say again slower? Can you please say again slower? Sorry. And it was Theodora who was replying.
Okay, no worries, no worries. I say it again. We did in the previous example that you are buying something from Canada, and the price of 1 Canadian dollar rose from 50 cents to 75 European cents. So it means that if Canadian dollar becomes expensive, or if the Canadian dollar appreciates, it's bad for you. It's bad for the Finnish company if this Finnish company is importing from Canada. In the second example, the Finnish company is exporting to Malaysia. Okay, is exporting to Malaysia. And your Malaysian customer will pay you in Malaysian ringgits. But then you have to bring this money back to Finland. And the Malaysian rate of exchange, imagine, was 1 Malaysian ringgit is equal to 1 euro. It means 2,000 ringgits will be equal to 2,000 euros. But now the market mechanism or the price mechanism comes in action. And now the new exchange rate is 1 Malaysian ringgit is equal to half euro. Now your 2,000 ringgits are not equal to 2,000 euros. Now your 2,000 ringgits are equal to 2,000 multiplied by 0.50. half a euro equal to 1,000 euros. Earlier, you were earning 2,000 euros. Now you're earning 1,000 euros. And why it happened? It happened because the currency in which you were exporting has depreciated. In case of Canadian dollar example, you are buying something from Canada, and if the Canadian dollar appreciated, you lost. In this example, you were exporting to Malaysia, and if the exporting country's currency depreciates against the domestic currency, which is euro in our case, then your revenue goes down. So the market is very cruel. If the importing currency appreciates, your cost will rise. And if exporting currency depreciates, your revenue will fall. Even though you are importing same amount of raw material, or you are exporting same amount of goods and services abroad. So the third point is also very valid, that you have borrowed some money from some British bank, and you not only pay the interest to this British bank, but you also make the payments in pounds. So the same point as in point one, if pound appreciates, it's bad for you. Because then you have to pay more money in the form of interest. In the same way, now I'm relating it to point two. Imagine your company have the deposits, not that you borrow, but you have a deposit in the American bank. You are a Finnish company, but you have the bank account in the American banks, and the American banks give you interest. American bank gave you interest in American dollars, but you want to bring this American dollars back to Finland. And if American dollar depreciates against the euro, you get less money. So basically what I'm trying to make out, or what I'm trying to emphasize, is that there are many risks we can identify, but one common risk which we can all encounter is that if you are a multinational company and your cost and revenues are in multiple currencies, your assets are bought in different currencies, your liabilities have to be met in different currencies, it's quite possible that the exchange rate fluctuations can cause you a lot of harm. And in this case, in such case, we often have to take the derivatives, which Murray asked me, which I'll explain it in a short while. So this is some background of this topic. If you're a corporate manager, you will have several risks, as you can see here. It could be possible that you are earning revenue. Let's say you are a company, a Finnish company, who is making sales to Australia, but all the production capacities are built in Bulgaria. Okay, now I want to ask you something. You are a Finnish company making sales in Australia, and your costs are paid because you have the factories in Bulgaria. What are your risks? But before you answer me, I want to. So I repeat my question to you. You are a Finnish company who's making sales to Australia, and the Australian customers are paying you, of course, in Australian dollars. And you are manufacturing this product, which you sell to Australia. You manufacture it in Bulgaria. And in Bulgaria, of course, your costs are in Bulgarian currency. My question to you, what is your worry? But before you answer, you know what? Risk is two types. The one is the good risk, and the other is the bad risk. The good risk is that I go back to my previous example when you were buying something from Canada. What if Canadian dollar depreciates and you are making sales to Malaysia? And what if the Malaysian ringgit appreciates? It will be like a river of milk and honey, that your cost currency is becoming cheaper or depreciated. Canadian dollar, you're buying the raw material from Canada, it's cheaper now, and you're making sales in Malaysia. And the revenue was coming in Malaysian ringgit. And now that Malaysian ringgit has become expensive or appreciated. It's a bonanza, it's a jackpot. It's a good risk. Risk is that every time there's something fluctuate, there is risk. The question is that this risk could be beneficiary or harmful to you. The risk which I just mentioned, that if the Canadian dollar depreciates and the Malaysian ringgit appreciates, is a good risk. We call it upside risk, upside risk. But in the businesses, we never take success for granted. We always keep prepared for the rainy days, for the bad times, we call it, in the accounting words, we call it conservatism. We are always conservative. We are very shy of recognizing the premature success. But we always prepare ourselves for the forecasted or would-be or the potential risk. So we always prepare for the downside. You know, what is the saying that hope for the best and prepare for the worst. So we always hope that something good will happen, but we always account for the bad things. We never count the revenue unless it matures. We never count the success unless it comes. But for the failures, we always be prepared for, and we make some arrangements already. Okay, so please keep in mind before you answer my question, is that the risk is not always bad. The risk can make you richer, but that's a good risk. That's an upside risk. But what we are more concerned, what we are more worried in this task too, is the downside risk. The downside risk, as we discussed before, that if the Canadian dollar appreciates, you don't make 500 euros payment, but you make 750 euros payment. It's a bad risk. And when you are exporting to Malaysia, and the Malaysian ringgit is no longer equal to 1 euro, but is a half a euro, then your 2,000 Malaysian ringgits are not equal to 2,000 euros, but they're equal to 1,000 euros. So in such situation, you have the double whammy. You get battered by both sides with the rising cost and the falling revenue. Okay, so we always account for, we always are concerned about the downside risk. Okay, so as I said before, you have to answer me now. The first point, the company earns revenue in one currency, but costs are paid in another. So I make it more real life example that your revenue come from Australia and your cost is in Bulgarian currency. What is your problem? What is your worry? Oh, sorry.
Can I say?
Of course you. Yeah. So there is you said it very right, Mari, that if the Australian dollar depreciates, you get less money in euros from Australia. But if the Bulgarian lev, the currency appreciates, you end up paying more money to the Bulgarian company. I want to say something, that the risk could be that your revenue increases because Bulgarian lev appreciates against euro, and your cost can go down. Your cost can go down because Bulgarian lev depreciates. And same way, your revenue can go up because Australian dollar appreciates. But that's an upside risk. If it happens, take it with both arms. Embrace it. But as a conservative, as a cautious business people, when you are a multinational company who is having a trading links with almost every country on the planet, then you can't take success for granted. You have to prepare for the the downside risk. Okay, so that's why we are more concerned about if Australian dollar depreciates and if Bulgarian lev appreciates. Or as in my previous example, if the Canadian dollar appreciates and the Australian dollar in that case depreciates. So in that case, the Malaysian ringgit depreciates. So in such situation, we have to be more watchful. So we're always more worried about, more concerned about the downside risk that we face. Okay, that's the first point. The second point is that the time difference between the date when the prices of transactions are determined and the payments are actually made. Now imagine, I want to put this situation in front of you, and please, you solve it. You might have to use some calculator or a piece of paper or a pencil to make these calculations. You are a company based in Finland, and you use a lot of oil, the petroleum products. And it happened that you bought, I will not say the quantity, you bought something for 2 million Saudi riyal from Saudi Arabia. And when you bought this oil worth 2 million Saudi riyal, the rate of exchange was a Saudi riyal is equal to 1 euro. But the contract says that you don't have to make 2 million Saudi riyal. You don't have to go to the till point and swipe your card then and there. Neither you have to carry the briefcase full of euros. The deal is that you will make them payment after 1 year. So this 2 million Saudi riyal, which worth oil, you buy from Saudi Arabia. The rate of exchange is 1 Saudi riyal is equal to 1 euro, okay? And the payment you will make after 1 year. And after 1 year, what happened is that 1 Saudi riyal is equal to 1.25 euros. What happens to your cash flows?
Isn't it so that you should use the exchange rate that was when you made the deal, not the later one? I mean, like, if you make a deal now and I have to pay it later, aren't we gonna, or no, well, whatever, I'm sorry. Yeah. Yeah, nothing.
Yeah, you're right. Yeah, whenever there's a time difference, we take some kind of financial insurance. The financial insurance is that's exactly what, Mari, we call them derivatives, basically. So when you buy from Saudi Arabia 2 million riyal worth oil, and when this deal was done, when this contract was signed, on that day, 1 riyal was equal to 1 euro. And then you make a deal in the same contract that, hey, we will make you payment after 1 year. And when that 1 year comes, on that day, in the market, the Saudi riyal is equal to 1.25 euros. The question here is that what you have been doing for this whole year? Well, you have been living in a world of uncertainty. Every day you were thinking, hey, is Saudi riyal expensive or cheaper than yesterday or next day? So you are living yourself, you are basically were living in an unwanted zone of uncertainty. What perhaps you could have done when you signed the contract a year ago, that you could have made some kind of arrangement with the company that, hey, we would pay you this, let's agree, let's negotiate that we would pay you this particular rate of exchange after 1 year. And had you done it, Saudi company would have been very happy that they knew that even though the money will come after 1 year, but they knew right in the beginning that how much money in Saudi riyal they will get. And the Finnish company would have been very happy that whatever has been the rate of exchange after 1 year, they would pay certain X amount to the Saudi company. So everybody would have been very happy. Okay, like in case of insurance. Like in case of insurance, when you buy the car insurance. If you don't buy imagine the car insurance is not a regulatory requirement, it's optional, okay? Then you know for sure when you take the car insurance that how much premium they will pay. And you know that you pay the premium, and if there's a breakdown or there's an accident, something, you know, you don't have to worry about it because then the insurance company will take care of it. But if you have the option not to buy the car insurance and you never know. It can be a small dent costing you a few €100, but it could be a complete breakdown of the car, which can make your car actually useless. But if you take the insurance, then you are happy. You know for sure that how much your loss can be maximum. So it's like that. So when in the global transaction, when there's a time difference between, and imagine if you are a multinational company, that was the reason exactly I asked you that you must choose some big companies. Because in the big companies, there's always a gap between the revenue, between the revenue you earn and the money you get. So there's always a time gap, except for the retail companies. If you are a B2B type of companies, making fixed goods, durable goods, which can last. You are an oil company, you are a petrochemical company, you are making aircrafts, you are an automobile company, making those haulage, the big trucks, like Scania and all that, or you are some kind of manufacturing company, heavy engineering product company. Don't expect your customer will buy a product from you and just go to the till point and make a payment. No, it doesn't happen like this. Sometime I know for sure that for some oil companies, you may make payment. Your payment can last for 5 years. So you don't make all the payments in the one go, and you make payment in parts and parts and parts, and it can last for 5 years. So in this case, if you don't take any insurance, insurance is exactly where I want to bring your attention to, that how the financial insurance, that is how we make use of risk management policy of the company to mitigate, to minimize the risk. And the one risk, which can be a very big risk, is the exchange rate fluctuations, because your transactions are taking at one point of time and the payments are settled at another point of time. And in between, things can change. Things can change for good or bad. But the question is that if you are a company, do you want to live on the market's mercy on a daily basis? It's a very unprofessional way of doing it, especially when you are a multi-million company and you are going for transactions into dozens of currencies. You can't live in this kind of approach. You have to be very proactive, head on, and take the challenge in the very beginning, and make some arrangements that you don't face so much of exposure in the later time. So time difference between the date of transactions and the actual date of payment given or payment earned is a very important time. I can give you more examples about it. If you look at the point 3, a European company, let's say Finnish company, you're producing in Eurozone, so your cost is in euro, so that makes no impact. But the export goes to the USA. So, but if the US dollar depreciates against euro, it can be killing. It can be killing. But if the American dollar appreciates against euro, it's a gift for you. But don't take this gift for granted, but always be ready if the dollar going to depreciate. Same way, the European company selling in Europe, let's say Finnish company selling in Eurozone, but all the cost, all the manufacturing is done in China. And if Chinese currency appreciates, it can be killing, okay? But if the Chinese currency depreciates against euro, it's good for you. But once again, we never take the good things for granted, but we always be prepared for the bad times. Same way, the European company, the Finnish company, let's call it Finnish company, manufacturing in China and exporting to the USA. In this case, the bad risk or the downside risk is that the Chinese currency can appreciate against euro and dollar can depreciate against euro. That can be very, very lethal. That your Chinese currency appreciates, it means you pay more money to China in euros, and the dollar depreciates against euro, it means you get less euros from America. The good news can be that Chinese currency depreciates and dollar appreciates, but we don't take it for granted. Okay, we prepare ourselves for the bad things, the bad times.
Can I say something?
Okay, the first, remember that we have listed now many examples in which, or whenever we are worried about that when it comes to cash outflow, we are scared of the foreign currency being appreciated, going up. And when it comes to cash inflows from the other countries, we are afraid of those foreign countries' currencies depreciating against ours. Okay, the question is that now we know that, hey, there's a virus, there is a medicine. The first medicine which we can use, the first remedy that we can use to minimize, not to remove, but to minimize this risk is called the forward contract. The forward contract. The forward contracts, I speak slowly. The forward contract is an agreement between a company and a bank to exchange a specified amount of foreign currency at a specified rate of exchange for a specified amount and for a specified time period, the date of maturity. I think I make an example for you, then things will become better. Only focus on the first 4 sentences, that a forward contract is an agreement between a company and a bank. Now, let me take you something. Let me open a Word file, and actually I copy it so that our argument remain valid there. I think I should give you an example, otherwise we'll be lost. Let me see if I can share it with you. Document, yes, I can share. Yep, I hope you can see it. A forward contract is an agreement between a corporation and a commercial bank to exchange a specified amount of currency at a specified rate of exchange and on a specified date in the future. Now, a Finnish company buys raw material from the USA for 30 million. 1, 2, 3, 4, 5, 6. And the market rate, the market exchange rate now, a Finnish company buys raw material from the USA on what date? On 19th March, which means today. And the market exchange rate today is $1 equals to, I'm not sure, but let's call it What's the sign of euro? 6? No. Number 6? No. Okay, euro. I can just type in euro. Euro. Let's say 0.80. The payment will be made to the US company by the Finnish company on June 30th, 2020. What are the risks? Please tell me, what are the risks? When you see this scenario, that there's a Finnish company which buys raw material from the USA and the deal is done, the contract is signed on 19th March 2020, I'm sorry, it's not 2010, it's 2020. And the market rate of exchange today, which is 19th March 2020, is equal to €1 or $1 is equal to euro 0.80. Please remember that if you always write the 1 unit of the foreign currency to the left side, I mean, this will be very wrong if you type €1 is equal to how many American dollars. Never write like this. Never write like this. So, for example, the most horrible mistake you can do is, I'll explain what the reason why it's is €1 equals 1.25 American dollars. Never, never write like this. Never write like this. Because you're living in Finland, okay? You make payment not in euros. Can you see the cursor? You make payments not in dollars, but in euros. So therefore, you must write like this. So always write the 1 unit of the foreign currency to the left side equal to the number of units of domestic currency. Domestic could be that if the example is, if we talk about the Finnish company, then the domestic region is Finland or Euro. If I talk about some American company buying from something from Canada, then the domestic becomes America. So that varies from question to question. But the point I'm trying to make is that once you know that which company is domestic company, that company's currency should always be on the right hand side. Must be on the right hand side. Must be on the right hand side. So in this case, the company is a Finnish company, a European company. So the rate of exchange should be in euro on the right hand side, and the unit of the foreign currency should always be on the left side. If you happen to write like this, it can be a big mistake. I will come to this thing afterwards, but not now. But okay, so please be aware of this thing. But the point I'm trying to make here is that when you see this statement, what do you think are the risks here? Where is the risk?
Teemu
What can happen
replied.
in these 3 months? Huh?
Teemu already replied in the chat.
Okay, you answered. Okay, wonderful.
Teemu.
Teemu has done it. US dollar appreciates, and therefore you want to, excellent. That's a good point. Now what happened? The US company, the Finnish company, I'm writing it so that the script remains there. The Finnish company goes to, the Finnish company is afraid of USD appreciating against euro. And this company, the Finnish company, goes to Nordea and explains its worries. That is, the USD may appreciate against. I'm sorry if this is, I think I should have also put it on mute. But anyways, I'm a teacher, I have special privileges. That is a USD may appreciate against Euro. Nordea suggests, hey, don't worry. I have a solution for you. Let's agree. I propose that I can offer you $1 equal to Euro right now. This will save you. So whatever is the rate of exchange on 30th June, you will remain unaffected. The Finnish company agrees to it. And the contract is signed. And it says $30 million, 1, 2, 3, 4, 5, 6 USD will be supplied to Finnish company at the exchange rate on 30 June 2020, and this contract is locked in. This is the forward contract. Does it make sense?
Yes.
Okay.
I have a question.
Just a sec. Mari, you wanted to ask me something.
Yes, about the seller's point of view.
Mm-hmm.
The Finnish company makes this agreement with the bank. Is
Mm-hmm.
it usual or not usual at all to tell to seller that there is this kind of a contract? For example, if the seller starts to wonder if the buyer really
who's
can't
seller?
buy.
Who's
The seller is
seller
the
here?
US company. No,
Okay.
I am talking about the contract between the companies, between
Mm-hmm.
the selling company and the buying company.
You can do it. You can do with that. You can do directly with the company as well. But normally the companies don't encourage
okay.
it. Normally the companies don't encourage it.
Okay, but I was just thinking about that if the Finnish company makes the contract with the bank, will the Finnish company tell the US company that we have this contract made, we will be able to pay you no matter what happens in 3 months. If the US company starts to wonder if the customer will be able to pay in general, if the 30 million has turned into 40 million, for example.
See, Mari, you have to keep in mind that I will ask you to repeat your question, but after I give my statement, this exchange rate fluctuation between dollar and euro is not going to affect the American company. American company are selling in 30 million American dollars. They want 30 million American dollars on June 30th, 2020. It is the buying company's problem how to solve this problem of dollar going up and down. And that's what they approach the bank to make this kind of arrangement.
But if the US company sees that their own currency is appreciating very much, they can start to think that if the Finnish company has possibility to buy so many dollars.
In this example, the American company is selling something in dollars, they're getting in dollars, they are not exposed to any foreign exchange fluctuation.
Yes, I understand that they are not they will get the 30 millions.
Yeah.
But they can, if they follow up so much that they know that their own currency is appreciating so heavily that they could start to wonder if the Finnish company will have a possibility to purchase 40 million US dollars to get it converted into 30 million from the receiving banks or the receiving company's point of view.
No, I'm not getting your point. How does 40 million comes in between?
I will rethink and ask you again. I think there is a point, but I cannot explain it properly. After break, maybe.
Okay, because I'm not getting how the concept of 40 million comes in between, and why US company is sympathetic to this Finnish company. Well, the one possibility can be that the foreign okay, let's put it this way. Let's say the dollar is so dwindling, so much fluctuating that the American company requests the Finnish company, hey, don't pay us in dollars, pay us in euros. In that case, the Finnish company would be certain already. It doesn't have to worry about fluctuation. The Finnish company would know that it would pay some X amount of euros. Okay, no exposure, no fluctuations, exposures. Then the exchange rate fluctuation exposure goes to the American company. Then they would buy some forward contracts. Okay, so it depends upon which currency we're talking about.
I rethink and
rethink and come back, Mari.
Yes.
Rethink and come back. But this is the whole situation of the forward. It's very important that we are not reading from the slides, but we are rather have created some situation that there's a Finnish company. It will buy something from America. The deal is done today. The payment would be made after 3 months. 3 months almost. The market rate of exchange is dollar equal to euro 80, 0.80. But we know that we don't make such payments on daily basis. There's always in the big transactions, even they are B2B or B2C, doesn't matter. There's a time gap. Okay, the question is that what happens during this time gap? The good news could be, the good risk could be that American dollar can become cheaper or appreciate against euro. But we never take it for granted. We are always worried about the downside. So the upside risk, we are conservative. We never take it for granted. So all we are worried is that downside risk. Because the downside risk is that on 30th of June, when the day of payment comes, the dollar can appreciate to anything, and that can kill your cash, your liquidity so much that it can be beyond comprehension. The question is that atmosphere, and so we want to cover our position. We use a phrase, we must not follow the naked position. Naked position means uncovered position. Uncovered means no insurance. Uncovered position, which basically means no insurance. No insurance. Yeah, you can't remain uninsured. If you remain, it's your risk, but it's a big risk. Don't take it. Okay. So then you go to the bank. It could be a domestic bank. It could be, you can even go to directly to HSBC or Bank of America. That's not, there is no patriotism. There's no national issue. You can go to the big bank sometimes. Or if you are not able to go there, then you go to the domestic bank. Like in this case, you go to Nordea Bank and you say that, you know what, sir, the bank manager, we are having this problem. We are scared of American dollar getting appreciated. And then the Nordea Bank's manager does some calculations and say, hey, let's make a deal, regardless of the market rate on June 30th. Let's forget whatever happens on June 30th. Don't care about it. I give you a offer rate that, hey, make it 85 European cents for $1 American. Let's make it a deal. So I can save you from all type of fluctuation. And if it suits you, remember, it's negotiable. You are negotiating with the bank manager. Okay. So this rate has, this rate or the forward rate, the forward rate has emerged out of negotiations between the Finnish company and Nordea Bank. So what's the word we use across the table? It's like so this is over-the-counter rate. We use another phrase, over-the-counter, or we call it OTC. OTC rate, which means there's no, it's like a negotiable, the way you bargain or negotiate with somebody that, hey, somebody's charging this. When you buy the house, somebody says, oh, I take 130,000 euros, and okay, my offer is 125. Okay, and then you negotiate. So it's like a negotiation. There's no fixed thing. It depends upon the negotiation rate. So that's why we use the word over the counter. That there's a counter. There's one side is the bank manager. The second side is the company manager sitting, and you negotiate. And after negotiation, you say that, all right, let's make a deal. The $1 equal to euro 0.85. And that's it. Okay, so that's why it's a forward rate or the over-the-counter rate. But let's take a break of 10, 15, maybe we start at 3 o'clock sharp. So you have 11 minutes, grab a cup of coffee. But I would say that before you come, after you come, after the break, you read this question by yourself and try to develop some questions and queries and doubts so that we clear them right now before we go any further. All right, so we take a break now. So we resume at, let's say, 3:05. Have a good break. So now we have one more example. In the previous example, the Finnish company was buying something from the USA, and the Finnish company was paying in American dollars, and the Finnish company was afraid of the dollar appreciating, okay, because that could make your cash outflow more. It's an extra burden. But in this example, You are a Finnish company and you make a sales to Australia, and this is for 40 million Australian dollar. And this transaction is taking place on 19th of March 2020, that is today. And today, the exchange rate in the market, you can see, is that 1 Australian dollar is equal to euro 0.75. But the thing is that the Australian company will pay on 31st of December 2025. In this case, you have a big risk. The big risk is that for Australian company, 40 million Australian dollar will remain 40 million Australian dollar today or 5 years later. Doesn't matter, because they are making payment in their domestic currency. No impact. 40 million, 40 million. They know that they have to pay 40 million Australian dollars. But the problem is with you, because those 40 million in euros can be huge or can shrunk. So the foreign exchange risk, fluctuation risk, is on your end. Your end means, in this case, it is on the supplier's end. My question is, what is your risk in this case? And how can you hedge it, for example?
The Australian dollar depreciates. That's the risk. The Australian dollar depreciates.
Very good, very good. So you are afraid if I copy and paste the text, which I did, and then try to modify it, maybe that will be great. Because then I can modify the text according to this example. Okay. Okay. So imagine the Finnish company receives payment, receives revenue. Okay, that's for revenue. On 19th March 2020, so it will receive 40 million, so it's euro 30 million, yeah. But unfortunately, this is not the case, because the Australian company will make payment on in 2025, 5 years later, more than 5 years later. The upside risk is that if you keep your position uncovered, naked means no insurance. If you keep your position naked, then the upside risk on 31st December, December 2025 is that the Australian dollar appreciates. It becomes expensive and you get more money. But we are conservative, we never take it for granted. So we always look for the downside risk. So the downside risk is that on 31st December, (2025), the Australian dollar depreciates. So this can be killing, depreciates. Just imagine that 1 Australian dollar, to begin with, it was 0.75 when the day this transaction was signed. And just imagine that Australian dollar depreciates. It becomes so cheap, worthless, that it becomes equal to 0.25. And you know what? How much money you will get then? You will get 25 cents multiplied by 40 million. So your cash flow can devastate, absolute devastation. So if you multiply this with this rate, this will be not 30 million, but 10 million. Can you afford to live in this such uncertain business atmosphere? So I just copy and paste. So we must not follow the naked position. Naked means uncovered or no insurance. So what you do on March 2020, the Finnish company signs a forward contract, which was here, yeah? Sorry, did I make a change? Yeah. Okay, so this should be the part of question as well. The Finnish company. So, okay, so what I do here, I copy this text here and change accordingly. The Finnish company is afraid of Australian dollar depreciating against euro, and the company goes to Nordea and explains its worry that the Australian dollar may depreciate against euro. Nordea suggests, hey, don't worry, we have a solution for you. I propose that I can offer you $1 Australian for euro. We can decide because it's negotiable. It's across the table, over the counter. Let's call it 73 right now. So whatever is the rate of exchange on 30th of December 2025, you will remain unaffected. The Finnish company agrees and the contract is signed. And the contract says that 40 million Australian dollars will be given to the Finnish company at $1 Australian equals to 73. Yeah, 73 we agree. Yeah, 73 on 31st December. On 31st December 2025. And this contract is locked in. This is the forward contract. And I can calculate that if it is Australian dollar 40 million, 140, 1, 2, 3, 4, 5, 6, multiply by euro 0.73, which is a contract. So you will get, the Finnish company will get all together euros 73 times 4, 29, 2, 1, 2, 3, 4, 5, 6. So you will get for sure, look at the beauty. The beauty is that on 19th of March 2020, you know for sure that come what may, whatever happens in the global markets, on 31st of December 2025, you will definitely get 29.2 million euros. What more assurance you want? What can be more ensuring? Sorry, what I have done. What could be more? This is such a big relief that you know for sure that you will get 29.2 million after 5 years. And this contract is lock-in. So lock in the sense that on June 19th, 2020, today, you make this contract. The contract is signed, and after 5 days, this Australian company cancel the contract. But then you can't cancel your contract with the bank, with the Nordea bank. You have to provide them 40 million Australian dollars after 5 years, and in turn they will give you euro 29.2 millions. So, I mean, that is something which you can't negotiate. Okay.
Stupid question.
Yeah. No question is stupid.
Will this be anyhow bind together with the company who is sending the money?
No.
This Finnish company. That there's no need for that.
Yeah. Because look at the Australian company. Australian company is buying from you as if it is buying from another Australian company. Because they're not converting a currency to another currency. So that's not their problem. Unless they want to accommodate you, that we discussed before.
Okay,
unless they want to take some partial risk on their side, or they want to favor you. But in the normal commercial transaction, they will not care much about you. It's your risk. You're selling it, and you agree to sell in Australian dollars. Okay, you could have insisted the Australian buyer to pay you in euros, but the fact that they have not paid you in euros, they want to pay you in their own currency. It means that the terms of trade are in favor of your buyer, who is based in Australia.
What
so
about banks?
The buyer wants to push the risk towards your side.
Yes. How about the bank's position? I was thinking that when, okay, they will give us the money, but what is the bank's relationship with the incoming money from Australia?
Look, on 31st of December 2025, you have agreed with the Nordea that on 31st of December 2025, you will give Nordea 40 million Australian dollars. That's your problem, you arrange. And the bank, at the rate of 73 cents, will transfer 29.2 million euros. So the bank will buy from you 40 million Australian dollar. Bank will never run away from you. And you have to provide bank 40 million. It's your problem how you arrange it. And the bank in turn,
Okay, now I understand it. So that those are like two different transactions, actually.
Yeah. No, try to understand. It's not two I don't know how you say two different transactions, but let me make my case. Let's say that nothing is cancelled. On 19th, okay, let's see the chronology, how the timeline. 19th of March 2020, you sign a contract with the bank, Nordea, that you will be getting 40 million Australian dollars from Australia, and you are afraid that dollar can lose value, can depreciate. Nordea says, don't worry, let's fix at this 73 cent rate, and you agree. So you know for sure that on 31st of December 2025, you'll have 29.2 million euros. But in turn, the money which come from Australia will be taken by the bank, Nordea, and the bank will hold 40 million Australian dollars, and bank would release to your bank account. Bank means Nordea Bank will give you on that day, after 5 years, 29.2 million euros. Okay, that is a situation when everything goes fine. So it's a one transaction, but basically it's dealt now and after 5 years. The second possibility is that the contract is cancelled. The contract with the Australian company is cancelled, but not with the bank. With the bank, you can never cancel. It's lock-in. It's a one-way traffic. You can never cancel it. Then in this situation, you must arrange, you mean the Finnish company, must give 40 million Australian dollars. That's your problem how you arrange it. You must arrange 40 million Australian dollars. On 31st of December 2025, you'll transfer to the bank's bank account, and the bank will give you in turn euro 29.2 million, 29.2 million euros. If the contract is cancelled, contract between you and the Australian company is cancelled, you cannot go crying to the Nordea bank that, hey, our actual contract is cancelled. So we will not be selling anything to Australia. Australians will not give us any money in Australian dollars. the contract is cancelled, can we also cancel the contract with you? And the bank will say, sorry, not possible. The contract is locked in, no cancellation. It's irrevocable contract. That way you are right, that you make two contracts. One contract is between Finnish company and the Australian company, that you would provide them something and they would pay you 40 million Australian dollars after 5 years. The second contract is between you and the bank. Okay, so that way there are two different contracts. The bank Nordea have nothing to do with this Australian company. They don't know them. They don't need to know them.
They have to, on 31st December, somehow connect our contract with the bank and the incoming 40 million Australian dollars, and not let it arrive at as it is to Finnish company's account. So actually they have to like kind of connect this payment arriving to this Finnish company.
Well, it could be possible. Yeah, usually it happens that you buy the contract from the bank where you have the bank account. So even in the absence of forward contract, the Australian company would deposit 40 million Australian dollars. Where? In your bank account.
Yes, and then if there is no forward contract, then it is converted into euros if it's a euro account.
Yeah, that's right. Okay. So this is the forward contract. This is a very old-fashioned contract. This is quite strict, but at the same time, the beauty is that you don't have to buy and sell it in the market. You don't have to go to any stock exchange to buy it. You just have to sit in front of your bank manager, and if there's a so you can do it online as well. So you just have to negotiate with the bank officer. And that's why we use the phrase over the counter, OTC. It's negotiable.
Can you say if there are certain companies like which are still using this, because this was a new case for me. So I was wondering that if this would be suggested for the startup companies or certain areas.
No. Never use it for a startup company, because there is a certain minimum amount of transaction you have to have. Unless the startup company is making big sales. I would say that for Australian, it could be maybe 1 million or something. Like each country, each bank have a minimum limit. So if you want to go on holidays to Canada, you can't use forward contract unless you're a very rich person. So for the normal low value transactions, you can't use forwards. The forwards could be involving a couple of hundred of thousands of the currency units. So there is a certain minimum contract size. Do you know what I mean? You can't make a small contract.
Yes, I understand.
Yeah. So if you're a startup company, I know the startup companies in Uvascula, which makes millions of euros and of sales and purchase. Of course, they would be using it. And if you have a company's PDF, you have the company's annual report, whatever company you have chosen. If you type in forward in the PDF, you will see a lot of information about that, how often. And almost all the big companies, all the multinational companies, almost all of them use forwards quite extensively.
Is it something that can be used in a big projects like paper machines with the long payment terms?
That's right. That's right. So almost all the big multinational companies, they use the forward contract. Okay. So please explore this concept, even though we haven't done slides today, but I have no regret, because I think it was good that we discussed it from this Word file and the situation and the scenario and we could have better discussion about it. From my side, this topic is over. Of course, we can have discussion next week, next time when we meet. Next time will be in 2 weeks' time. Next week is your presentations, and Seher has made a list of the order of presentations. I would suggest you that we all should be present, even though the presentation is one by one. Go through the rules that Seher, is it 10 minutes per group?
Yes.
10 to 12 minutes, yeah?
Yes, 10 to 12 minutes following by the 3 to 5 minutes discussion.
Yeah, some discussion, yeah.
Yeah.
So make sure that you all have good cameras, everything. I would like to see the faces of the presentation team members. So your mics, your camera should be on. And because now the problem is that you can't sit together in a group and do the rehearsals. I would say that you must do the rehearsals properly, so that everybody is making contribution to the discussion. And try to be, I'll be a bit strict this time about the time thing, that the time should be, whatever is written is followed strictly. Otherwise, it can last for many, many hours. So we can't have the liberty of making a 20 minutes long presentations. No, don't do it. Go strictly. And the best thing to be in the time frame is to do the rehearsals. Do rehearsals through Zoom by yourself. Okay, yeah. You will be, because there can be a problem that you can't show you can share your screen with me. Each of you can share your screen with me. But just in case you are not able to share your screen with me, you should have sent your slides in the Optima return box, so that when a group is making a presentation, you don't have to show me your slides. I can open from the Optima return box your slides. Okay, you don't have to show it to me. And then slides should be numbered, or everything, go through the instruction, everything is mentioned there. And if we have a question, then I can stop you afterward that, hey, on slide 7, you said this thing, what does it mean? So you have your, so you'll be having the Excel sheet. So when you make a presentation, I would open your Excel and the other files, for example, the PowerPoints, I will open it so that I can check your calculations and I can relate it to what you're saying. So please don't ask me a minute before that, hey, we have forgotten to upload the file. Can I do it right now? Can I email you? No, don't do it. Let's follow the same rule for everybody. So if the deadline is on 29, is 28th?
25th.
28th, yeah?
25th.
25th.
Yeah, 26th is the presentation day.
26th is the presentation day, and 25th is the, yeah, all right. So please follow it strictly. So no more changes afterwards.
Fine.
All right, so if you have anything to ask me, you can. Otherwise, we can say goodbye. And then I can send the file to you. I can send this recording to you so that it sticks in your records. You have something to say, Seher?
Yes, I just want to say that if they have any questions related to their assignment or related to their presentations, they can ask right now from me. If you are here, they can ask from you as well.
Yeah,
Because
if you have any questions, please feel free.
I have a question related to